In the autumn of 2008, the world watched a 158-year-old financial titan dissolve overnight, not through fire or violence, but through spreadsheets, derivatives, and the quiet panic of traders staring at numbers that no longer made sense. It was a collapse without smoke, yet its shockwave circled the planet. How could a crisis built inside boardrooms and balance sheets bring the global economy to its knees, and why did so few see the fracture forming beneath them? To understand 2008, we step back into the long build-up, a decade where credit felt endless, risk seemed obsolete, and the American housing market was treated as an engine that could only move upward. Banks, mortgage lenders, ratings agencies, investors, and regulators formed an ecosystem of aligned incentives. Each wanted growth. Each trusted the same models. Each assumed the system could self-correct. It was a high-confidence era fueled by low interest rates and rising home ownership. By the early 2000s, US home prices had been climbing for years. Between 2000 and 2006, national home prices nearly doubled. Analysts warned it was unsustainable, but the warning was drowned out by demand, optimism, and the belief that real estate never falls nationwide. The core mechanism was simple. Lenders issued mortgages to millions of Americans, including many who could not realistically repay them. These were labeled subprime loans, high risk, high interest, and often structured with deceptive features. Banks then bundled thousands of these mortgages together into financial products called mortgage-backed securities. The logic was that pooling risk made it safer, and ratings agencies often stamped them as high grade. These securities were repackaged again into even more complex instruments called collateralized debt obligations. They spread across global markets, purchased by pension funds, insurance giants, hedge funds, and foreign banks. On paper, the system looked diversified. In practice, it was a Jenga tower of interconnected bets, all dependent on one assumption: American homeowners would not default in large numbers. Early cracks appeared in 2006. Housing prices stopped climbing. Adjustable rate mortgages began to reset, pushing monthly payments sharply higher. Default rates ticked up. Analysts called it contained. But nothing in a tightly coupled system stays contained for long. By 2007, major lenders specializing in subprime mortgages collapsed. Investors noticed that certain mortgage-backed securities were producing far lower returns than expected. Confidence, the invisible foundation of finance, began to erode. In August 2007, global markets seized when a major French bank froze 3 investment funds tied to US mortgages. Banks began questioning each other's exposure. Credit, the lifeblood of modern finance, began to shrink. The Federal Reserve cut rates. Emergency loans flowed. Institutions reassured clients, but below the surface the models failed. The data was worse than expected. Losses grew faster than analysts could chart them. In March 2008, Bear Stearns collapsed under the weight of bad mortgage assets. Its failure was absorbed through a government-assisted takeover. The shock was immense, yet many still believed the worst had passed. That belief evaporated on September 15, 2008, when Lehman Brothers filed for bankruptcy, the largest in US history. The global financial system, already fragile, was now in freefall. Interbank lending froze. Markets plunged. Overnight, the crisis became undeniable. Money market funds broke the buck, something once thought nearly impossible. Corporate borrowing halted. Banks hoarded liquidity. Within days, the US and Europe faced the most severe financial panic since the Great Depression. The crisis triggered a cascade of emergency actions. Governments around the world provided capital injections, guarantees, and rescue packages. Central banks slashed interest rates to near zero and opened unprecedented lending facilities. The US Congress approved the Troubled Asset Relief Program, a massive effort to stabilize the financial system by purchasing or insuring distressed assets and recapitalizing banks. Despite fears of moral hazard, policymakers faced a stark reality. The collapse of one major institution had nearly imploded the global economy. Letting the full system unravel was not an option. But the damage extended far beyond Wall Street. The crisis sent shockwaves through households, labor markets, and governments. Millions of Americans lost their homes. Unemployment surged. Retirement accounts were wiped out. Global trade contracted at the fastest pace in modern history. Factories closed. Government deficits ballooned as tax revenues fell and safety net spending increased. In Europe, the aftershocks magnified pre-existing weaknesses, contributing to the sovereign debt crises that unfolded between 2010 and 2012. Nations like Greece, Ireland, Spain, and Portugal faced severe fiscal strain and international bailouts. Financial regulation entered a new era. The United States introduced stricter oversight, higher capital requirements, and new rules for derivatives and systemically important institutions. Yet debates continued. Some argued the measures did not go far enough. Others warned they went too far. The unresolved question remained, could regulators truly prevent systemic risk in a globalized financial system? Economic policy also shifted. Central banks embraced unconventional tools such as quantitative easing, directly injecting liquidity into markets by purchasing government and mortgage securities. This era of low interest rates and asset purchases pushed investors toward equities, real estate, and alternative assets, contributing to a decade of rising valuations and new fears of future bubbles. Public trust in financial institutions fell sharply. Many viewed the bailouts as evidence that the system protected corporations but not citizens. This sentiment fueled political movements, economic skepticism, and debates over inequality. Globally, policymakers studied the crisis as a case study in systemic fragility. The event demonstrated how quickly modern financial networks transmit risk and how interdependent the world's economies have become. Emerging markets, though not at the center of the collapse, felt the fallout through tighter credit conditions, currency pressures, and declines in foreign investment. Banks rebuilt capital buffers. Stress testing became routine. Risk models were re-evaluated, transparency improved. The system evolved, though many structural patterns remained. The crisis also accelerated the rise of financial technology. Distrust of traditional institutions created space for new platforms, new payment systems, and eventually cryptocurrencies, reshaping markets in the decade that followed. Historians identified the event as not only a financial failure, but a governance failure, a moment when incentives, assumptions, and oversight collectively broke down. Yet despite its magnitude, the crisis followed a familiar pattern. Long periods of stability often breed the conditions for instability. The most dangerous risks are those that become invisible through complacency. The housing bubble, the credit boom, the complex securities, each was visible on its own. The danger came from their connection, their amplification, and the belief that mathematics had eliminated uncertainty. By 2010, markets had stabilized, but recovery was uneven. Households took years to rebuild wealth. Governments remained constrained by debt. The psychological impact lasted even longer, shaping the risk appetite of an entire generation. For economic historians, 2008 stands as a defining turning point, a moment when modern finance revealed both its power and its fragility. It was not the first global crisis, and it will not be the last, but it remains a blueprint for how risk travels in the 21st century. Today, echoes of 2008 appear in debates over leverage, liquidity, shadow banking, and digital assets. Policymakers still ask whether it could happen again. The answer depends less on models and more on memory. The lesson of 2008 is not that finance is inherently unstable. It is that stability breeds narratives of invincibility. The system faltered not from a single failure, but from a chain of assumptions treated as truth. Collapses rarely begin with explosions. They begin with quiet signals, rising defaults, ignored warnings, small imbalances compounding in silence. The catastrophe appears sudden only because the buildup was overlooked. The unsettling truth is that systems break where confidence concentrates. In 2008, confidence gathered around housing, mathematics, and the belief that markets correct themselves. Each assumption became a blind spot. Financial history is a cycle of forgetting and rediscovery. Crises recur not because the mechanisms are mysterious, but because the patterns fade from collective memory. And so the story of 2008 remains unfinished, not a closed chapter but an ongoing archive. Its warnings persist for those willing to listen. After everything learned from 2008, one question remains: which assumption today carries the same hidden risk we once overlooked?